again, thanks for everyone who's on and potentially joining in over the next few minutes. Great to have you guys here. Just as quick introductions, obviously my name's Sean Laidlaw. I'm from Seedling. Today, obviously with me is Sebastian Chapman, the other co-founder of Seedling. And we're joined as well by Peter Templeton, who's a Nuffield scholar and farmer, and going to give us a rundown on his research report. And as well, Matt Dilly, who's the Agri-economist for ANZ. Just as we step through just some formalities, there's a Q&A feature just at the bottom of your screen, and Sebastian's just sending a message there on how to access that. So, if you do have questions, please don't hesitate to fire them through, and anything that we don't get to as we step through, we'll come back to everyone individually. Maybe, Seb, do you just want to start with a quick background on Seedling for us?
Yeah, cool. So Seedling basically came from an idea I had that came out of my own problem, and I'll go into that story a little bit later on. But we've basically come out with a financial product that is looking to get the next generation of farmers into the next generation of farming. We observed that there was a massive capital gap for the next generation of farmers to get into farming, and also there's a huge capital gap for people looking to retire and get out. So we've built a pretty innovative, novel financial product to solve that issue, and yeah, we're rolling that out to the wider public now.
Yeah, great. Yeah, so I guess just stepping forward then, Matt, maybe we'll start with you. Obviously, great to have you here. ANZ's obviously at the forefront in terms of banking and in the agri-sector. I think, tussling it out closely with Rabobank for 1 and 2. But it'd be great just to, get your insights in terms of what you're seeing out there.
Yeah, thanks, John, and thanks, Sebastian. So, hi everybody. Matt Dilly from ANZ here. Just a quick little disclaimer before we get underway. Neither myself or ANZ are endorsing any product or service by Seedling. This is not personal advice, and all that sort of good stuff. So, with that out of the way, Sebastian, are you on the controls for that? Yeah, we'll just go on to the next slide after that. So just a week or two ago, I published a report, our Agri-focus report. So a lot of the information you see in here, you'll also see in there. I encourage y'all to subscribe on the ANZ website or have a look there and see what else we've got cooking in there. So so we're focusing on the dairy market. Global prices are still really high. Over the past year or so, demand has been really strong, and outside of New Zealand, production has been relatively weak over the past 18 months or so, and that's been a huge driver of what we've seen in the commodity markets from about mid to late 2023 to present. And it's really been butter that's been holding everything else up. It's the demand for that has been unstoppable effectively, and there haven't been a lot of alternatives in the market coming out of Europe or anywhere else. So that's what's led to the $10.15 final price that Fonterra is going to announce next week, plus or minus 5 cents. But we have started to see over the past 3 months or so a bit of weakness in the markets. Part of this is just a natural response that the best cure for high prices is high prices. OCD here in New Zealand has commissioned a new butter plant for this season. Fonterra, my former employer, they're doing everything they can to maximize butter production this coming season. And also, folks in Europe and the US have gotten that message as well. So there's quite a bit of butter coming out of the Northern Hemisphere now as well. And then in the Southern Hemisphere, South America, we're starting to see a nice recovery in production. in Argentina and Uruguay, and even Brazil. So, so that's going to, provide a bit more competition on the whole milk powder side. So, all that put together, that's what's been driving prices lower, and we expect prices to continue to sort of drift lower, especially this time of the season where the New Zealand production is getting online and getting underway, and we are expecting that to be a big year for New Zealand as well, production wise. So things will drift lower, but a lot of sales have already been booked at these current prices, and we've already got, when we're looking at it, maybe a $10 payout. That's what our forecast is. That's that's kind of incorporating some price weakness from here. So, but a lot of sales have already been booked at the current prices. So this slide here, team. This is just a generic food price index from the UN, from the United Nations. But it paints a pretty good picture that the expansion signal is there as strong as it's ever been. The world wants more milk. Grain prices, a key input for feed, not in New Zealand, but in North America, Europe. The signal is there. Inputs are cheap, including soybean meal, and milk is really valuable. So please make more of it. And people are getting that message, and that's what's starting to come through, particularly in the U.S. And that's what's driving things there. And then we've had a weak New Zealand dollar over the past year or so, and again, dairy farmers don't have much to complain about for the season that's ended a few months ago. Really high commodity prices, weak New Zealand dollar, and for the most part, good weather. There's a few exceptions to that. Southland had a bad spring, and there's a bit of drought in summer, autumn in parts of the North Island. But overall, production was up 3%. So that was kind of a win-win-win for the sector at large. And this next slide, Sebastian, this is what dairy farmers have been looking at. Really over the past, the prior two seasons were basically a wash in terms of profitability. Of course, there's a huge amount of variation within that group, but it's been a few years since we've had a year like this. Even if you don't count the Fonterra, the additional dividend from Fonterra that's likely as a result of divesting the consumer business. It's still been a really good year, and we're expecting this current year to be nearly as good. This year that's just starting off, but you can see also the cost structure for a typical dairy farm has gone up as well over the past couple of years. It is starting to stabilize, so that's good. Interest rates are starting to go down. That's good. So farmers are in a much better position now to pay off some debt and look at some other on-farm and off-farm investments with what's coming down the road for them in terms of payouts. And of course, if they're a Fonterra shareholder, then they'll be feeling extra good about things at present. And the last thing I'd like to talk about before we get into a bit of Q&A. Again, please fire some questions through. That way we can talk about things that are interesting to the folks that are on the call. Volatility is an enduring feature of dairy. So this is my kind of pitch for folks to not be afraid of that volatility, but to embrace it. And there are mechanisms out there specifically for dairy that can help farmers manage their price risk volatility through whether it's the Fonterra Milk Price Protection Scheme or some other products that are available on the market, kind of using that same framework as a mechanism. It's with all the volatility that's around there out there in the world right now. This is one way for folks to take control over the cost side or the revenue side of their budget. It's not enough to just grow, just make a lot of milk. You've also got to harvest that that price and get the most out of your milk in the market. So this is a good way to protect yourself and lock in a positive margin for your business. And it's things aren't going to get less volatile going forward. Maybe we'll have a few questions about tariffs and everything in the Q&A, but that's what we're seeing. So
Yeah.
I think,
Matt, maybe just quickly, I mean, obviously, we talk here about some of the volatility. Is ANZ seeing much activity through like the futures and fixed milk pricing, or are farmers generally comfortable to sort of let things run over the next 12 months?
there was a bit of a downtick in activity in the Fonterra Farmgate milk price pool a few weeks ago. But I think there's still a lot of farmers that are hesitant to get involved in these sorts of financial products. We aren't offering anything specifically ourselves, but I'm encouraging folks to have a look at that as they manage their risk. But a lot of folks have been stung in the past about interest rate swaps and whatnot 10 years ago or 30 years ago. So it is a bit of a there is a bit of an education piece in addition to making sure those tools are available for farmers to take a look at. But it's not something that's Sean, it's not something that's just for large corporate farmers or wild speculators or anything. It's it's a legitimate price risk management tool. It's not something that should be that every farmer should at least be thinking about.
Yeah. And then I guess just you've sort of touched on it, but the Fonterra sale, from a supply and demand side, is there any sort of major talking points maybe that ANZ's seeing that haven't been covered already, or just interested to get the bank's take?
Yeah, well, the farmers are going to be high-fiving themselves to sleep at night, I think, if they're a Fonterra shareholder. It's if it was a much lower number, then maybe folks would be thinking twice about whether it was a good thing to vote on. But I think with this number, it's it'd be hard to turn that amount of money down.
Yeah. Just to quickly as well for those online, we will send out a copy of this presentation, and Matt, your contact details are in this as well, aren't they?
Yes, they are. Yeah.
I guess maybe just finally, Matt, this is probably an important thing, not just for agri, but for all of New Zealand. Interest rates, where do you see them heading?
Yeah. Good question, Sean. So the Q2 GDP came out actually just earlier this morning. So this is the quarter we're talking about is April, May, June, and it was minus 0.9% quarter over quarter. So that was a lot. That was lower than our estimate of minus 0.4. I mean, we were on the lower end of the range, but even this was quite a bit lower than what everyone was expecting. So what that means is, we were already thinking that a drop in October, an OCR drop in October was a lock with what the RBNZ was, with what the Reserve Bank was saying and looking at, and all the numbers they were looking at. But with this, I mean, there's even a slight possibility that they could go further than a 25 basis point cut in October. That's still probably unlikely, but it also increases it was already quite likely for there to be another cut in November, heading into their slow period. They don't meet again until February after that. So so this does increase the odds of a further cut in November, which we were already calling for. So we're calling for 50 basis points over the next two monetary policy announcements. And then the other side of the coin on that is that inflation is, they are worried about the economic recovery at this point, and that's what they're turning their focus on. Inflation is largely under control, even though the numbers are a little bit higher than they'd like at the moment. A lot of that sort of transitional pricing, and this is probably not the right word for it, but there's some like council rates and insurance things that they're viewing as kind of one time, that we're viewing as well as kind of one-time hits that'll start to come off the boil, come off the stats, come off the inflation numbers in the coming months. And then also the tradables inflation has been quite high, and a lot of that's driven by dairy prices and meat prices, which are both quite strong. So that'll start to moderate too. And typically the Reserve Bank focuses more on the non-tradables, the domestic price movements, rather than the stuff that's driven by global commodity price movements like dairy or oil.
Yeah. Yeah, great. Well, obviously you've got your disclaimers in here to make it.
Yeah. So this is the part where I read all of this out verbatim. Yeah. Are there any questions from the floor? Sorry, I can't see the Q&A thing on my screen.
No, that's all been covered so far. But like I say, if anyone does want to reach out to Matt, please feel free. And then as well, obviously we'll send this around. So Matt, I know you've got to shoot. So great to have you. Thanks very much for coming.
Yeah, thank you very much, Sean, Sebastian. Enjoying it. I think I might hang on for a few minutes and hear what Peter has to say until I head off to my next meeting. But yeah, appreciate the time, everybody. Thank you all. Yeah,
so obviously next cab off the rank, Peter. You've just finished a Nuffield report looking at succession issues within New Zealand. Yes, obviously as well you're farming. So it'd be great to just get your insights, maybe a bit of background first on what a Nuffield is and what it looks like.
Yep, no worries. Well, just for the crowd, I'm a fifth generation Southland dairy farmer, right in coastal Southland. Family's been in the farm's been in the family for 100 and something years. So I got the opportunity to get into succession really young, running the farm business at 25 years old. So I sort of felt a bit of guilt. So I went off and decided to do a Nuffield scholarship around succession to sort of see, are there better ways that we can do this, or are there more opportunities for people like me to get the opportunity that I had? So that was my aim. The Nuffield is really, you get scholarship to go out there and research whatever you want. You had to do a couple of things. I had to go to a couple of countries as part of my requirement, but really it was go off and study what you want, find the answers that you're looking for. So that's what I did. I started off heavily in the family and corporate succession model, but as I keep going around the world, I keep sort of seeing that this pathway progression was getting more and more interesting. So I wrote half my report really on succession and the benefits of the ways we can better do business and corporate and farming succession, and then also talking about how do we maintain this pathway and this career progression from starting out in farming to farm ownership, because to me that became even more important when looking at the New Zealand outlook as a whole. If we don't maintain status quo, we are going to have some pretty fundamental changes. So, and the way that it all is structured in the future. So that's sort of a little bit of a brief about my report and what I did. I could probably bring up some of the graphs. So these are just just to paint the picture. This is from Rabobank and this white paper that I helped to provide a lot of information into. We sort of worked together. But their graphs are a lot prettier than mine are. So, in all honesty, we use these ones. So, just really basically showing. I mainly want to focus on the farm owners by age. In every country I went to, farm ownership levels are increasing the average farm ownership age is increasing by 1 year every year across the 15 countries that I went to. And it's a growing problem. At the same time, the thing that seemed to be the most in line with that was that the capital requirement to get into ownership was increasing at the same time. So that capital ownership was holding a lot of people back. So just really focusing on the point that over half of the ownership we've got in 2023 is over the age of 55. And going through everything that I saw about farm succession, the minimum year, the minimum time it takes to do a farm succession successfully is about 10 years. So if people want to be out by 65, they need to start by 55. So we're talking about, in New Zealand, it's about 48,000 farms. So we're talking about half of these farms, 24,000 farms, needing to start now, today, on succession. And we just didn't, we don't have the infrastructure in New Zealand to facilitate anywhere near this right now. And a lot of people are sort of flushing it and putting it in the too hard basket, which brings me on to my next point. And we just go one more slide over, please. Just showing the range of, farm owners' age is going up at the same time the number of total farm owners is going down. At the same time, the workforce is also dropping a little bit. That's with automation. People, that's the way farming's going, is we will see that overall total workforce go down. At the same time, we're also going to continue to see total farm owners go down, which is because of corporates, bigger entities taking on more farms by multiples. That's the trend I'm seeing all over the world, and especially here in New Zealand. At the same time, the age increases. So all of that, when businesses get bigger, the capital requirement goes up, and it becomes either a bigger stepping stone to get into. So all of this puts more pressure. What I wanted to talk about really briefly is the real estate market that we have. The farming real estate market we have in New Zealand is relatively fragile, and it's relatively fragile around the world. It's all based on supply and demand in the moment. As much as we think that there's lots of things coming on there, if you've got motivated sellers and not motivated buyers, everything, the price drops and so on. So it is quite fragile, and there's a lot of things at play there. But unless we continue to see a replenishment of the people who have been buying farms in the last 5 or 6 months, because farmer confidence right now has been really good. And again, this is hard to fact check, but I don't think there's people replenishing the people who have just bought farms. I think the people who could afford to buy farms in the last bit have bought their farm. I don't think there's a replenishment of the stock of people coming forward. And so that, to me, raises some potential alarm bells around where we're going. And through all of this, the people who ultimately lose are the 65-year-old farmer who is a bit slow to sell his farm. And then suddenly there's no buyers out there for him, and he runs out of options really quick. That's the person who ultimately loses. If we don't have a pathway of young people coming in with the ability to afford and the want to take on the farming business, the people who ultimately lose are the people who have put 50 years of hard effort and toil into their business and then suddenly don't have options. So, that's important to keep that in mind. And that's what was a bit of a shock for me, because, you always think that when you've got the asset, it's great. But if you're a farmer who's put their life into it and then suddenly no one wants to buy it, it's emotionally difficult thing to deal with, as well as being financially very difficult. So that's the risk that we had. I just wanted to go one more slide over. Oh no, might not be there. Just in terms of since 2002, when I was doing my numbers for my report, the average dairy farm was worth like 24.3 times the average farm manager's salary in 2002, and now in 2022 it's now 64.3 times the average farm manager's salary. And in that same amount of time, yes, it's easy to say there's been a lot of changing in the structures and levels. There's now many levels behind. People don't just go farm managers straight into ownership. There's many more levels. But just to I use that as an example of just calibrating how much it's really grown. It's really a 3 times capital investment if you're a farmer just earning a wage now than what it was in 2002. And that's now a significant jump. And even to afford a deposit on a house might only take you 5 years, but to afford a deposit on a farm might take you 25 to 55 years, depending on what you're going for, just by saving half of your paycheck. And so farming doesn't look like such a good investment anymore if there's no real capital gain or a potential risk of not having a flat capital gain versus housing. It's hard to get into. There's lots of other barriers here. So what I like to talk about is that we used to have, especially I'll focus on dairy farming here because it's a really clean analogy, but we used to have this river that we used to try and cross. So on this side of the river is starting out, and on this side of the river is farm ownership. And we used to have all of these little stepping stones that we could go across. So you had this rock and this rock and this rock. Used to be farm managing, contract milking, lower order share milking, 50-50 share milking, lease to buy or equity partnership, and then your own property outright, right on the other side of the farm ownership. And what I've noticed in New Zealand and in lots of other countries, UK, Germany especially, is that lots of these stepping stones are changing themselves. So the person who was a contract milker put that same contract milker on as a 50-50 share milker, and then that stone has now been removed from the path across the river because it's not being replenished. And then the 50-50 share milker sells the farm to the 50-50 share milker or to somebody else, and then that farm gets removed from the river. So now you've got to do a bigger jump to get across. And that jump takes more time, but most of all, it takes more capital. So that's sort of what I was seeing very clearly. And then bringing all that information back to here to New Zealand, what we need to try and work at is just how can we make more different pathways to get people into capital, and also how can we focus on people getting equity transfer at the same time they're making farm management decisions, because we see a huge lag in New Zealand in particular from farm management decisions being made here, and then 5 to 10 years later there's an equity transfer to that person over time. So is there ways that we can do more gradual transfer of equity to the people making farm management decisions in the moment? Because if we can do that, then people are incentivized to stay. And the last point is that the new generations, me being an old school millennial, I probably went around traveling, looking at all these young people being grumpy the whole time. So, but the younger people are way more focused on the journey as opposed to getting to the destination. And that's happening over in every country that I went to. It was especially important in Brazil and other South American countries. They were really focused on, if we're going to go and own a farm, it needs to be beneficial to us now. We need to be able to have a lifestyle and support our families. We don't want to do hardship in order to get to your destination, which is really hard to get to. So, and in terms of trying to keep these young people who are the basis of our future, and corporate farms only go as far as the management. So if we want these good managers to be incentivized to continue to increase their progression up to ownership. And the reason we want to do that is there's a huge risk here that if we don't have enough people coming in, it's just going to be corporates getting bigger and bigger and bigger, and having more managers, contract milkers in the dairy side of things, and more soft landing points for people on this career ladder that they can get off and just stay to the side. And ultimately, the reason we want to do that as a country is that ultimately the people who suffer are the 65-year-olds, 70-year-olds who have worked their entire farming life with the plan of selling their farm when they retire. The risk is on them suddenly, but it will be quite hard for them to realise that, and it'll be quite hard for that message to be pushed forward that the fact young people aren't coming in is putting a risk on me and my asset that I've worked hard for. So that's sort of where I've come to, and coming back into why I'm interested in being involved here at Seedling is it's in this different innovative ideas to get people into farming. I'm all for it. We need as much different ideas and options as we can get.
Yeah. Well, I mean, obviously, we sort of think it's a great idea, but I guess just in terms of what you saw, maybe in some of your travels and things, like, did you see any markets that were doing it really well, or products out there that potentially were helping?
In terms of succession, the funny thing I got everywhere I went was, "Why are you doing this as a New Zealander? You guys are the best of all of us," and that's not what we see in New Zealand. It's sort of what people think of us is that we have more young farm ownership than we actually do. I saw snippets in every country of people doing it really well in multiple different ways. I saw family corporates work really well in America. I saw quite a few that was really interesting. They get to generation 3, suddenly the business is massive, and they want to go to generation 4, but in order to suddenly accommodate from the 12 to 14 that were in it to 24 to 25, they have to expand in a massive way. Like in a log scale, they have to double to triple their size. And they were trying to grapple with that. versus offering the fourth generation a lower shareholder value than what everyone else was offered when they come in. That was something they were grappling. So family corporates work really well up to a point. I think they will have a natural life cycle where they'll get too big for themselves. I saw some people going through the tenant system in the UK really well, tenant farming. To the right people doing that, that was really interesting. At the same time, just before all these rules come out, these rule changes about taxation and estate. Trying to think of the right word here. The estate tax that they had over there. There's a lot of young people getting offered 20 to 25-year tenancies, which would never have happened before. And those people that I went and saw, they didn't think they put in the highest offer. So these landlords were offering longer tenants to people who were probably going to invest in the business and improve the assets of the business, I think would be my gut feel from what the landlords were looking at. So there were interesting trends happening all over the world. I saw people doing really innovative stuff in the Netherlands. One guy in particular, he crowdfunded and had a farm shop that he would offer. He would basically get borrowings from his clients, and he would offer them interest as a credit through the farm shop in particular. And so they would come onto farm, use the farm shop for their interest, and that sort of stuff. There's lots of really interesting things happening out there. And that individually was a farm that was worth, they say, 124,000 euros a hectare, and it's 42 hectares, and he crowdfunded to make it work. So impressive. There's cool things out there, but I didn't see any country singly getting this right. I saw lots of snippets of it working and not working.
Yeah. And then maybe just lastly, I mean, obviously, so figure 11 there, we've seen, 20 years farms are getting bigger. And I know people probably like to say that farms, improve slowly over time in terms of capital value, but they have in the same time period, gone up quite significantly. Obviously, land use change and pushing around the edges, but, you touched on that period in terms of the time to save a deposit. Do you sort of feel like if we don't probably get something right soon, there's going to be an ownership vacuum, and we're going to see larger landholders and probably the family farm might drop off?
I think we're already seeing it, and I think we're already seeing it, but I do think we're getting clouded with this shroud of there's a lot of farm sales going to these people, but a lot of them are already a family farm buying another farm. And as much as we don't want to think about that, I mean, my family started off with one dairy farm, and then we bought 4 pieces of land around us. We've actually become a family corporate. So it is going to its own level of family corporate. Eventually, you're going to have management and ownership separated, and the opportunity for the management to become owners is limited, not in every business, but just in general. So I think in some sort of term, we're already seeing a lot of this going into corporates. And so I think we'll see the death of the small family farm that probably doesn't have much debt, and so therefore not motivated to act quickly. Generally, I think we'll see a slow tapering off of those farms in particular. The ones who are heavily in debt, the banks are putting pressure on them to make decisions anyway. So I think if they're at a scale or they're highly leveraged, we'll probably see them move in the right direction. I think the people who are low debt, running relatively safe funds, that may not be continued, and that may die pretty quickly. And I think we're going to see a pretty big corporatization of New Zealand farming, unless we figure out more pathways very quickly within 5 years.
Yeah. I mean, we've certainly seen cases of that, farms being swallowed, and like you say, I think that the probably the traditional idea of single herd, mum and dad is certainly fading.
Yeah, and the economies of scale of dairy farming in particular, especially when you've got buying power, even within your own single business, really can accelerate that process quite significantly if you've suddenly, because you can produce more milk solids, you can get your costs down, you can get more lending, and there's sort of as a snowballing effect there of this medium size getting to large quickly.
Yeah, great. Well, that's probably as good a place as any, and thank you, Peter. Certainly, paints a picture of, in terms of the problem that we're trying to solve at Seedling, and just the scale of it here in New Zealand. And like you say, I mean, there's obviously opportunities around the world as well for a working model.
Plenty.
So that takes us obviously onto Seedling, and hopefully what in a way, what everyone's here to hear about. Seb, I'll hand over to you just to give everyone a rundown.
Yeah, cool. Thanks, Sean. I'm going to keep the tempo fairly quick because I realise we are chewing through time. So, yeah, let's rip into it. Next slide, Sean. So, I grew up on a small farm in the Manawatu. Absolutely loved farming and everything about it, and wanted nothing more to carry on farming within my family. But succession of our own family farm was never going to be on the cards for me. Next slide, Sean. Left high school, went dairy farming, did that for about 5 odd years, and yeah, absolutely loved it. But whilst milking, you've got plenty of time to think, and I was thinking of pathways to try and get into farm ownership myself, and none of them really checked out. I couldn't see anything that would allow me to get there or get to getting a deposit before the time I was 45, 50, sort of looking back to some of the stuff that Peter was talking on. So yeah, left the farm with a bit of an itch to scratch on that topic. Went overseas, went to Aussie, jumped in the tractors, and whilst in the tractors, sort of came up with the loose idea of Seedling, and then ripped into it when about a year ago. So yeah. Sean, next slide, mate. So here I want to just focus on some of the macro data that sort of illustrates what I experience from boots on the ground as micro data. So if we look on the things on the right, you'll see Rabobank has identified that there's about $150 billion worth of farming assets that need to change hands in the near term, and that's from that report that Peter worked on with them. And we're also seeing a reduction in available farmland in New Zealand. So it's decreased by about 15% over the last 20 years. And then, yes, similar data as well. The average farm size has increased by 25%. So the average farm size is about 279 hectares. And yeah, the farm, yeah, sweet. Oh, you're right, Sean. I'll just get rolling. Then if we look sort of at the global scale of things, right? So on the left-hand side, the graph shows where the population globally is heading, and then the amount of arable land per person. And you can see that they're going in different directions. So this is going to create a market squeeze. The graph on the right shows the expansion of private equity funds in the sector. So the one I want you all to focus on is the bottom one, the blue. That's the farmland one. You can see it's grown massively over the last, 15 years. Yeah, next slide, Sean. And then if we look at the demand for high quality food, high quality proteins, you see it is growing massively globally. Quite interesting, on the graph on the left, you can see the amount of land use is reducing, although the production is going up. And if we look on the right, a lot of that comes from the poultry sector. So that sometimes does skew some of the data that you may hear about where, hey, we're producing so much more per hectare, we're going to have enough land. I think we're still going to have a squeeze on the land that we've got for things like dairy and meat. And this is an interesting one that's just some anecdotal data that sort of plugs into where the zeitgeist is a little bit at the moment. We can see whole milk is trending, and we see soy milk is staying flat. So, I think most of you guys may have experienced that whole milk is somewhat getting a bit of a resurgence. We seem to think so. So then how do we meet that demand in the industry? And I've just got a few quotes there from Beale, the Economist, saying that the industry employs 40,000 people. We're losing about 4,000 every year. So if we have a leak of 10% of the good people within our industry, how are we going to create the supply to meet the demand in the global markets? So that's where Seedling comes in. So Sean and I have been head down for the last year or so, nutting out a solution to solve this problem. And basically, we've found out that what we need to do is we need to align the incentives between the investors and the farmers so that they're heading in the same direction. We need to provide an opportunity for farmers to grow their wealth in a meaningful way, and we need a model that has a rolling liquidity so that investors can sort of meet their requirements. And then finally, we've got a huge opportunity whilst doing the succession change to make sure that we are farming in the most sustainable way, and we're also using as much of the technology available to be as productive as possible. So a big part of our investment thesis is sort of how do we start from fundamentals and then work up to where profit is generated and a system that scales. And fundamentally in farming, you're starting with some natural capital. You've got soil, you've got your water, you've got whatever the climate is in your region. These are the things that we think we can really build on some of the technologies that are out there and improve soil. There's options now for carbon credits if we're storing carbon in the soil. There's biodiversity credits coming on the market. Can we add in some other revenue streams that help sort of flatten out those volatility cycles that you come across in dairy? So yeah, that kind of leads on to cost structures. So I will hand over to Sean here. Take it away, mate.
Yeah, so I guess in terms of what we look for from an investment, our current model, basically we're focused on what we call tier 2 and 3 farms. So these are either might be underutilized, they might be mixed land use, or they might just have a historical cost structure that doesn't align anymore with traditional farm models, because we have seen cost pressures around fertilizer, energy, water. There's a number of things that have changed over time, and so for us, we look at each asset as an individual and say, yeah, okay, we can make changes here and there based on what Seb talked about in terms of that natural capital, and really utilize an asset better, and that helps improve those cost structures. Obviously, ownership, a big part of what we're doing, and sort of back to what Peter talked about is how we build those pathways for farmers to get into ownership. And so for investors and for the fund, what it really does as well is it aligns those incentives, so the farmer who is on the ground every day is making decisions as an owner. And so that aligns that decision-making process with fund outcomes, with cost structures, and just ensures day to day that, I guess, every decision is made from the viewpoint of the fund and of the overall financial return. As well, it just lowers that barrier to entry. So we, in the next slide, we'll sort of talk about this, but obviously, in terms of our win-win model, we've built a number of tools around how we contract these farmers and ensure they have financial resilience through the model, and all the tools they need to gain equity over time. And Seb mentioned this slightly, but what it really does for the fund as well is we now have added liquidity from an investment point of view. Traditionally, at scale, one of the down points of agri investments or of primary sector has been liquidity. Very illiquid assets, you've got to go to market, you've got to find a buyer, can take some time. But what this does is it allows us to move through assets over time, which we think is about a 10-year window depending on entry point. But that gives us that liquidity on an annual basis through the buyback period of the farmer buying back, that we can move into new assets and keep replicating the model and growing the fund. So that's why we sort of call it a win-win. Everything's well aligned in terms of what the farmer needs and wants, and then how we generate best possible financial outcomes for our investors. And so, yeah, just as I mentioned, traditionally, obviously what we've seen prior to seedling model, might be 55 to 60% debt gearing on a farm. As that farmer needs to sell, they then have to find a buyer for the whole thing. Where our model steps in is, we've had conversations with a lot of retiring farmers who would be willing to leave money in the farm. They don't necessarily have to, but it's a great option for them in terms of staying connected to that piece of land, because that's important to farmers. And then the farmer themselves who's stepping on site gets to buy in at a smaller stake, so really lowering that entry point. And then obviously debt still remains in the piece, but at scale we can better manage that across some of these tier 2 and 3 farms than historically probably what's happened. And yeah, so just in terms of at scale what we're looking to achieve, this primarily we're focused on dairy for right now. Obviously, as I mentioned, those tier 2 and 3 assets. We will own dairy support blocks. We've seen the costs, there as well in terms of how we can incorporate those internally to better support the farmers and minimize costs. Alternate land use, so that's what Seb sort of talked about in terms of right land best use case, just how we can really generate additional revenue streams and better land values from some of the marginal land. And then obviously as a requirement, farms are required to own Fonterra shares and some of the co-op shares, so the fund itself will hold some of those, and there's an element of that as well to being able to utilize for liquidity. So that's the presentation. So I'm just going to stop sharing my screen.
Cool. I'm just aware that the Q&A area is somewhat hard to find, so I've opened up the chat, and if anyone wants to just put their questions in through there, happy to pick them up.
Might be okay. If we'll try to get around everyone who is here today anyway tomorrow. So if you do have questions, feel free to hold them to then, and we'll get in touch. But yeah, I guess unless there's any questions that jump up now, we might as well just call it a day. Peter, thanks for coming. Yeah, hopefully everyone got something out of this, and like I say, we'll be in touch with everyone. So yeah, thanks very much.
Cheers, guys. Have a good day.